In this lesson, we will be discussing how to price bonds. To begin with, we will talk about the given information to do the actual computation. Later, I will provide you with some overview of how to think through the process of pricing bonds. I will show you the actual calculation based on the present value tables. Below here, I also have a little graphic or table that shows you the cash flows that come out of the bonds, along with the present value calculation for each cash flow. And then I also have here the schedule to amortize the bond discount, and I'll explain that as well in that sort of third section in this lesson. And finally, I'll show you how to account for two of the transactions that relate to the bonds. So let's go back to the top to review what is the given. As you might remember from a different lesson, we're going to be issuing bonds at a discount in this case. So that's what that says. The face value of those bonds are $1 million, so that's what you see there. The issue price is going to end up being $964,056. Now that's the answer to the problem. That's actually the actual answer. But the question here in this lesson is, how do we get to that answer? The term for the bonds, for this issue of bonds, is 5 years with 6-month semi-annual interest payments, so half-year periods. That means that we have 10 of those. The contract rate on those bonds is 12% for the full year. Again, since we're doing 6-month payments, we also need to take a note of the 6-month contract rate, which in this case will be half of the 12%. So 6% for the period's contract rate. The given market rate for similar type of investments is 13% per year. On a 6-month basis, that would be 6.5%. That's the given information for these bonds. Notice that we're going to be computing the price, as I said before. We'll prepare the table to amortize the bond discount using the effective interest method. In a different lesson, you probably have seen already the other method, the simpler method, which is referred to as the straight line method. And then we'll generalize the entries. In terms of general guidance for pricing bonds, the first thing you need to understand is what are the cash flows coming out of those bonds. So that's what I have here, step 1. Step 1 shows you that the contract rate, which in this case will be 6%, remember that 6-month period, will be multiplied times the face amount. So in this case will be the full $1 million. So if you do that 6% times $1 million, that results in $60,000 interest payments. And that refers to this second step here, the first part here. Cash flow per period. So we have 10 periods, so there will be 10 cash flows. Because you have a series of cash flows, we refer to this as an annuity. So we take the $60,000 multiplied times the present value factor that relates to this type of annuity, 10 periods at 6.5%. We use the market rate for this factor here. That means that okay.